What if I told you that markets don't just crash because of bad news? They often crash because people suddenly start believing everyone else knows something they don't. And that one shift from confidence to fear can turn a normal day into a panic in a matter of hours. Today we're breaking down why markets go wild, the psychology, the politics, and the economics behind crashes. Not just what happens, but why it happens, and more importantly, what you can actually do with that knowledge. Because market crashes aren't random, they're usually a chain reaction. The first ingredient is psychology. Humans hate uncertainty more than they hate bad news. So when prices start falling, people don't just react to the price, they react to what they think the price means. A small drop becomes a signal. A signal becomes doubt. Doubt becomes panic. This is called herding behavior. People copy what others are doing because in moments of stress, following the crowd feels safer than thinking alone. That's why markets can fall faster than the original problem would justify. A classic example, if investors see major funds selling, they assume those funds have information they don't. So they sell too. Then more people sell because the selling itself becomes the story. That's how fear feeds on itself. Now add economics. Markets are supposed to price in future expectations, profits, growth, interest rates, inflation. But when those expectations change suddenly, the whole system has to revalue fast. Think about interest rates. If rates rise, borrowing gets more expensive. Companies may earn less, consumers spend less, and future profits are worth less in today's dollars. That means stock prices can fall even if the company is still doing okay right now. In other words, markets don't crash just because the present is bad. They crash when the future gets revised downward all at once. And leverage makes it worse. When investors borrow money to buy assets, falling prices force them to sell to cover losses. That creates more selling, which causes more price drops, which triggers more forced selling. That's a mechanical loop, not emotion, but it often starts with emotion. Then there's politics. Markets dislike uncertainty, and politics is often uncertainty in its most public form. Elections, wars, trade disputes, regulation changes, central bank decisions, all of these can change the rules overnight. Sometimes the reaction isn't even to the policy itself, but to the possibility of the policy. If investors think a new rule might hit profits, disrupt supply chains, or raise taxes, they price that risk immediately. A good example is tariffs. On paper, a tariff can be a small policy decision, but markets may interpret it as higher costs, slower growth, inflation pressure, and retaliation from trading partners. So one political move can spill into multiple economic fears at once. Here's the useful part. When markets go wild, it helps to ask 3 questions. First, is this a psychology problem? Are people selling because they're frightened or because the fundamentals truly changed? Second, is this a liquidity problem? Are prices falling because there are too many sellers and not enough buyers? Third, is this a policy problem? Did something change in government, regulation, or central banking that alters the future? That framework helps you avoid one of the biggest mistakes in markets, assuming every crash means the world is ending. Sometimes it's a real economic warning, sometimes it's panic, and often it's both. If you're an investor, this matters in practical ways. For example, if a stock falls 20% because of a broad market panic, but the company's revenue, margins, and debt levels are still healthy, the drop may be more about sentiment than substance. If you run a business, you might use this to prepare for volatility. Hold more cash, avoid overleveraging, and stress test what happens if customers spend less or credit gets tighter. If you're just trying to understand the news, this lens helps you read headlines more intelligently. Instead of asking, why is the market down today? Ask, what fear is being priced in? Markets go wild when psychology, economics, and politics collide. The crash is the visible part. The invisible part is the chain of fear, incentives, and forced reactions underneath it. And once you understand that, market chaos starts to look less like madness and more like a system behaving exactly how humans built it to behave. Why markets go wild? The psychology, politics, and economics behind crashes is just one small part of the stock market: bubbles, crashes, investing basics. If you're interested, our full free The Stock Market Bubbles, Crashes, Investing Basics course is linked in the description.